Hey everyone, welcome back to Corporate Decoder, the place where we decode the language of big business. Today we're diving into a proxy statement from Crown Castle, and trust me, there's a lot more to it than just voting for directors. We are going to talk about amendments, restatements, and a lot of capital, so let's begin this castle tour. This proxy statement is packed with information about Crown Castle's upcoming annual meeting, who's on the board, how they get paid, and some key decisions shareholders are being asked to make. Big picture, it's all about the future of the company. Let's start with a quick summary. Crown Castle is holding its annual meeting in May and asking shareholders to vote on a few key things, including electing directors, approving their accountants, and making some changes to the company's charter, which is like their constitution. The board is urging everyone to vote for their recommendations. How did Crown Castle do in 2024? Overall, they did pretty well, despite some challenges in the wireless communications infrastructure market. Key numbers. Site rental billings increased by over 5%, but small cell deployments, installing the technology for 5G, decreased a lot, a 36% decrease, a big loss. Adjusted EBITDA, a measure of profit, grew by nearly 2%. All good signs that the company is growing. However, the return on their investment was negative, meaning they did not earn money on the investments they have made. Who are the folks in charge? There are 9 nominees for director, all with different backgrounds, from finance and telecom to technology and real estate. The board seems to be trying to build a diverse group with experience in different areas to oversee the company. It is worth pointing out that the board is being reduced by 4 members, which would result in more responsibility for the 9 remaining members. Crown Castle has had a separate board chair and CEO for over 20 years, meaning the same person does not hold both of those positions. They don't have a firm policy about this, which gives them flexibility to choose the best structure depending on the situation. The board met a lot last year, 22 times, and every director attended at least 75% of the meetings, which is a good sign they're engaged. They also meet without management present, having independent views. The company is making sure the directors are not over-committed, meaning they want to ensure that they have enough time for this job. Directors are expected to let the company know about invitations to be on other boards to avoid them spreading themselves too thin. Risk management is a big deal, and the board oversees the company's strategy to manage risks. Internal audit monitors everything, and senior management reports on cybersecurity risks. The company's biggest risks include weather events and cyber attacks. The board has several committees to handle different areas like audit, compensation, and environmental, social, and governance matters, ESG. The committees make sure that each critical aspects of the business are taken care of with subject matter experts and people with enough time on hand. Now let's talk about some specific people. Anthony Malone was recently interim president and CEO and is the chair of the audit committee. Andrea Goldsmith is a director who is also on the board of Intel and Medtronic, so has a lot of technical and leadership experience. Tammy Jones is the chair of the ESG committee, so is in charge of overseeing the company's sustainability strategies. There is a good mix of new and long-time directors to keep some level of diversity on the board. The company is saying that each member of the board standing for election is independent, meaning that they do not have any relationship with the company that would influence their decisions. They have standards in place to ensure this independence. How much do the board members get paid? They get a mix of cash and stock. Each year they get around $230,000 in stock and are also eligible to participate in our medical and dental plans. Those in charge of committees get paid even more. The audit committee, which oversees the company's finances, reviewed the financial statements and discussed them with management and their auditors, PricewaterhouseCoopers, PwC. They recommended that the board include the financial statements in the annual report. Crown Castle's top executives include people like Daniel Schlanger, who is the current interim president and CEO, and Catherine Peach, the chief operating officer for Towers. There has been a lot of recent turnover within executives at Crown Castle, with many executives joining, being promoted, leaving, or retiring. This can be unsettling to stockholders as the people in charge of the company have not been consistent. Here's where things get interesting. Executive compensation. This is always a hot topic. Crown Castle says they want to reward improvement in financial results and creating value for shareholders or make more money. So the top executives get a mix of salary, short-term incentives, and long-term incentives. This mix is heavily weighted towards at-risk compensation, meaning a significant chunk of their pay depends on how well the company performs. In 2024, the company decided to use a new group of peer companies to compare executive pay, consisting of other large companies. This was in order to reflect a more balanced peer group and reduce the effects that any macro conditions might have. In other words, their peer groups were not faring so well, so the executive pay might need to be adjusted in case other comparable peer groups were doing well. In terms of actual performance, the 2024 annual incentive plan was based on adjusted EBITDA and AFO per share. These are accounting measurements to understand profit. The company achieved near target performance but did not receive the highest payout. To make sure executives are aligned with shareholders, they have to own a certain amount of company stock. The CEO, for instance, has to own stock worth 6 times his base salary. That can get expensive. This encourages them to think like owners. Here we see a table with the director's compensation. There is a lot of cash that has been made due to retainers, and other compensation is attributed to the shares that they own. Finally, Crown Castle is asking shareholders to approve some changes to their charter, which is like their company constitution. They want to remove some outdated provisions and eliminate supermajority voting requirements, which means it currently takes a big 80% vote to make certain changes. If approved, it will now require only a simple majority. Why do this? The board thinks it'll make the company more accountable to shareholders and easier to govern. And so here comes the conclusion to our tour. In a nutshell, Crown Castle had a mixed year with the numbers looking generally upwards, is trying to position itself for future growth by reducing its debt and optimizing its capital, and is asking shareholders for some key approvals. There have been a lot of changes at the leadership level, so whether or not the long term can be consistently executed is another question. There appears to be some shareholder discontent because of all the recent organizational changes and the value of the stock taking a beating over the past years. We are not sure how far the company can go. If there's one thing to keep an eye on, it's their ability to manage all organizational transitions. Thanks for watching Corporate Decoder. That was a lot of amendments and restatements. Make sure to like, subscribe, and comment below.